Trading a Robinhood account from $3,000 all the way to $1 million, and I'm showing you every step of the way how I get there. As of Friday, November 14th, we closed the account at $26,372. We are down $15 on the day, and on the month, we are now down $5,700. So we've taken a pretty big step back in the portfolio. If you've been following along, we were around 38,000 at the start of November, but there's really just been an all-out bloodbath in growth stocks, roughly 30 to 50% across the board. There's just been a major sell-off. And right now, everyone's thoughts are, is the market going to crash? Are we heading into a recession? Is there an AI bubble? And I'm gonna cover that all here in this video, what my thoughts are, as well as get into some of these other positions in the account. We've been trying to de-risk as much as possible and then load up on high quality companies, which kind of gives you the answer of what I'm really thinking in the overall market. Now, this week we do have a lot of data coming out. We have information on PMI, inflation, consumer sentiment, the Fed meeting minutes on Wednesday, as well as manufacturing data. And then of course we have the big one, NVIDIA earnings on Wednesday. They're almost a $5 trillion market cap, so that can really swing a lot of the tech company names that we're trading in. So we'll see what they say for 2026, what their guidance is, as well as we have 14 Fed speakers speaking this week. So we're gonna get an indication of what their thoughts are. Are they gonna actually lower rates by 25 basis points, or are they gonna hold rates steady? Right now, the market is pricing in a 56% chance that they are going to hold rates and a 44% chance that they're going to cut by 25 basis points. So it's roughly a coin flip whether or not they're going to actually cut interest rates. Fear and greed is at 22. So there's a lot of fear right now in the markets that's been hovering down here over the last several weeks. You can see it's been bouncing up and down. The VIX is elevated. The market is kind of swinging back and forth, whipsawing. Of course, the government shutdown led to a lot of delay in release of all this data, which makes it difficult for the Fed to, they're essentially flying blind, right? They don't know what the data looks like for them to make a decision. So they're being very patient, but over the next several weeks, we're gonna have all this data coming out that's gonna influence whether or not they are gonna cut rates. If we just look at all the different sectors, you can see there's been a bit of a rotation out of the growth stocks, the interest rate sensitive companies. So like consumer staples, utilities, real estate, industrials. A lot of these have been, at least over the last 30 days, you've seen a shift into some defensive names like healthcare and energy. Tech is surprisingly held up fairly well, and that's just really just because the Mag 7 stocks are holding fairly well with like Apple and Google. You even had Warren Buffett buy into Google. But you can see here I have this sorted by the last 30-day change, and you can see like AMD has done really well. Amgen and Illumina are healthcare biotech stocks. You got Google, MongoDB, Amazon, Apple, Snowflake, and a few others. NVIDIA's held fairly well. But then if you go down the list, a lot of these growth stock names have had a really big sell-off. Even Cathie Wood's ARK Innovation Fund is down 12.3% over the last 30 days. And so really it's just been a full-on bloodbath rotation in growth stocks to value names. People are very worried whether or not we are in an AI bubble. And that's even showing up on Google Trends. People are just searching for AI bubble. Nonetheless, these are really the two scenarios that I'm looking at in the market right now over the next several months. And in scenario A, which is everyone's greatest fear, is we're right at the forefront of a recession. Growth crashes first, and then the S&P 500 follows. Now, usually the way that this would work is that growth leads the drawdown, so all those names correct first because they're high beta stocks, and then the S&P 500 follows over time, and then eventually everything bottoms together later. This is very characteristic of December 2021 when the Fed said inflation's running too hot, we are going to start raising rates as well as shrinking the balance sheet, so they're pulling liquidity out of the system. And over the first 6 months, the S&P 500, it was very volatile, but it only dropped like 5 to 7%. And then eventually there was a really big crash, 25% drop, and some higher beta stocks, specifically looking at ARK Innovation, dropped 60 to 70%. I think the NASDAQ was down around 35% as well during this period. That all bottomed together in October of 2022, and then it started to rally from there into 2023. And that was really just driven by the fact that the Fed was getting close, or at least jawboning, which is really just hinting at they were going to stop raising rates at some point. And then the market started to price in the future, and you saw growth stocks start to have a really crazy run, like Robinhood and Palantir and SoFi, and really all the darlings on Wall Street Bets, as well as Twitter. All those stocks started running really hard to the upside. But this scenario would mean that the market is at a local top and we're going to have a really big drawdown versus like somewhat of a correction. I'm more in the camp that right now we're seeing a positioning flush, or really just a sector rotation from growth to value. You have a lot of these crowded trades, and hedge funds are likely just flipping from risk assets to safer bets, and obviously a lot around the uncertainty if they're going to continue to cut rates, since growth is a long duration asset, really just meaning that it's very interest rate sensitive, right? Because growth stocks need to grow as fast as possible. If they can take on cheap debt with lower interest rates, then that will help them grow a lot quicker and recognize that revenue a lot sooner. This has happened pretty much the last 2 to 8 weeks. So meaning if it's already started about a month ago, maybe we only have 1 to 4 weeks left. That kind of lines up with my thoughts going into the FOMC meeting in December. And this has happened in the past before. It usually happens once every year or two. And here's a few different examples and how long that period lasted in biotech and SaaS and cloud and software, usually from 4 to 8 weeks. And the characteristics are big drawdowns and high beta growth, which we have. The S&P 500 barely moves, which we have. If I show you here on the chart, you can see that the S&P 500 is very volatile. We had the big sell-off here back in October. That was around the China trade deal, which now they're saying they're going to have a trade deal by Thanksgiving finalized, but the market's really only down like 2.5% from at least the all-time high of this wick. And then it dropped to around 4% on Friday, but really it's closer to around 3.5%. So there hasn't really been a big drawdown in the S&P 500. And we've even held this trend line multiple times now that you can see. But while this has been happening, the VIX is elevated, right? It kind of hovers around this 18 to 22 range, and that's very characteristic of what I'm talking about. So going back to here, there's also the credit and macro picture is healthy. You know, we just had earnings. Most companies are raising guidance for next year. They're spending more and more money. That's usually signs that there's not really any sort of credit strains. Obviously, there's a lot of debt that they want to fund for all these data centers to build out AI compute. But I don't think that the market is in a place where it's going to have a recession until all that debt is on the books. It's not going to happen before. I think right now it's just a lot of irrational fear around, is the power grid going to be able to support all these data centers? Is AI in a bubble? Is OpenAI just making all these different deals? You had Applied Digital that they were undersubscribed on their debt offering. So right now it's just like the sentiment on the space is very bad and negative, but usually that means that at least we're going to have some sort of a local bottom at some point, right? Everyone's selling, and at some point that all that aggressive selling stops, and then you're going to have a lot of aggressive buying and momentum chasing. But that doesn't mean that the market's going to bottom right here. It could certainly fall a bit further over the next few weeks, but ultimately I think this is really just a correction before we start to rally again in the markets into midterms with the government reopening. Really what happens when a government reopens is during the period of time that it's shut down, there's like an artificial contraction in GDP. So they're saying about 1.5% of GDP contraction during this period of time. And really, I believe that this is going to push off the recession, right? Because what you have is a bit of like a whipsaw or a bullwhip effect, right? So things are artificially closed down. They're not hiring. There's freezes. Maybe there's a bit of a slowdown in the private sector. But once the government reopens and things get back to working, then there's going to be a reacceleration of growth. So a lot of what didn't happen in Q4, it will likely start to show up in Q1 and Q2. And so I think that now my recession prediction is probably like late 2026. I think that we're going to continue to rally in the markets. I think this is just very much like a very short-term, short-lived correction that's going on. And then once we get more clarity around data, the job market and things like that, because the Fed, remember the Fed is not tightening. In fact, QT ends in December, and they're going to lower rates, whether or not it's in December FOMC or in Q1. At some point, they are going to continue to lower rates just because CPI and the job market is starting to slow. Unemployment right now is like only 4.3%, whereas like historical averages are like 5.5 to 6% over like the last 20 to 30 years. So the job market's not bad despite all the different layoff headlines that you're seeing. And really what I think is, yields are not spiking or anything like that. Really, I think a lot of this is just very much a rotation underneath the surface. No credit stress, VIX is elevated, but no panic. We're currently not in some sort of global deleveraging event or anything like that. Most countries and central banks are starting to get inflation under control, starting to lower rates and things like that. So, like I said, I think it's more than likely that scenario B is playing out. I could be wrong, but I'm buying companies of stocks that I think are going to do well over the next 12 months. And that's really what I'm trying to do here in the account. So a lot's going on. Gotta just be very careful, be very patient. But let's just like hop into the charts and I'll give you a better sense of where I think price is headed. Now, like I said, the S&P 500, it keeps wicking down below this trend line and it holds each and every time. So that's really bullish. Bulls continue to step in. We still have this little mini gap on futures that remains down there, but we are holding that trend line. Same thing with the NASDAQ. We do have that mini gap down here, but maybe we'll go back down and fill this at some point. But this uptrend continues to hold. Bulls stepped in and bought the dip here on Friday, and the VIX continues to, like I said, hover around this 18 to 22 range. This was a little bit overblown. That was just really around the China trade deal. But we are in a bit of a weird spot because although the index continues to hold, that if you look at the ETF SPY, which is regular trading hours, we're actually below that trend line, right? So we tried holding that trend line a few times. We dropped below it and then closed on it. But what you're seeing here now is a bit of like a gap fill and then really a two gap fill is what happened on Friday. So we had this gap that remained open. We filled it a few different times. We came back down, tested that gap area again, and then pushed back, filled the overnight gap as well as this previous bull gap. But we rejected this trend line. We weren't able to close above. And so right now, although the S&P 500 index is still above, SPY is still trading below. So a lot of uncertainty whether SPY is going to bounce and reclaim this trend line. That would be very bullish. And then, of course, we'd probably come back up towards this 680 to 683 and try to fill that bear gap that exists. Or things are going to head lower. We're going to probably come back down to this lower trend line. Maybe we could even break lower. So still, it's probably worth just trying to be as patient as possible. Looking at QQQ, kind of like a very similar pattern here as well. We keep bouncing on this $600 level, but whether or not we can hold and try to keep pushing higher is still yet to be seen. But like I said, the indexes are over, but the ETFs are still in a little bit of an uncertain spot. So we'll see how things trade there. But looking at specific stocks that we're really bullish on, obviously we talked a lot about Nebius on the last video. They did have earnings. And although I thought earnings were very, very strong, they raised guidance. They sold out of all their capacity, which could be seen as a negative because they don't have any capacity online. And so are there bottlenecks similar to what CoreWeave was talking about with delays around PowerShell build outs? But right after earnings, it was very volatile. It sold off to like around 100 pre-market. And then you had a bit of a retest here at 115. Bulls stepped in. I thought earnings went really well. Twitter was really all over this name, and it kind of pumped intraday, but then since then the market has continued to sell off and growth names have taken a beating, especially in the AI data space. So we saw this really big sell-off back to the Microsoft announcement gap that happened all the way back in early September. So right now bulls are trying to defend this gap. A lot of people are just saying that, price is going to go all the way back down to 64. Now, it's certainly possible that anything can happen in the markets. I'm not doubting that. We could definitely trade to 64. I mean, we could trade all the way back down to 43. Like, it's certainly possible. But looking at the fundamentals of a business will give you that comfort, right? The confidence, the conviction to buy into the stock. If you truly understand the nature of the business, the leadership, and what the future cash flow and what really the future holds for the business, then you're not really worried about buying a stock for the long term. Now, if it goes down here, I'm going to continue to buy the stock. As long as it keeps dropping, I'm going to sell everything in my account and buy Nebius. I've been buying a lot more shares. I now have over 60 shares and a few $1,000s in options. And the reason I'm so bullish on this stock is for really a number of reasons. If we go back here to their Q3 earnings, they raised guidance to $7 to $9 billion from about $4 billion previously in Q2. So over 100% increase in guidance by the end of 2026. Their contracted power is going to increase from 1 gigawatt to 2.5 gigawatt. And then their connected power is going to go from 220 megawatts to 800 megawatts to 1 gigawatt. So a huge increase in total capacity by the end of 2026, as well as their expected ARR, which is really just the ending revenue at the end of 2026. That's what their run rate revenue is going into 2027. Now, they did sell out of all their capacity, which could be seen as a negative, right? Because they need to build out the capacity. Not only the contracted power, which is really just like the land and having like power agreements in place, the connected power, which is actually developing the land and then connecting power to a PowerShell. And then they have to actually outfit the data center with all the GPUs and the hardware inside before they can actually get that capacity online and running and starting to recognize revenue. So there's a lot that goes into it. It's a very high CapEx business. There's a lot of people throwing out, different valuations and things like that. A lot of people are saying it's a $100 billion market cap business. Right now it's trading around 20 billion market cap at the current share price. I think safely this company is probably worth $150, my worst case scenario, over the next 12 months. But it could trade well over $200 to $250 by the end of next year because of really the leadership and how quickly they're able to get capacity online. When capacity starts to come online, especially around information on the Vineland, New Jersey data center, which is really the Microsoft deal, once that comes online, I think a lot of momentum is going to start to show up in this name. Now, there was also big customer wins. We did get the $3 billion Meta deal, right? So Microsoft, now Meta, and what are we going to do? Go fill the gap to 64? I'm just going to be buying the stock the whole way down. There's AI startups with Black Forest Labs as well as Cursor AI. So really, really sticky contracts, right? Because once you have your training in these clusters of GPUs, you're optimizing through Nebius's software. You're not going to want to switch, right? Because you're optimized and it's faster and it's cheaper. So very, very sticky product overall. They released Nebius Token Factory as well as their AI cloud, either around enterprise grade security and compliance. And then of course, AV Ride had the strategic investment with Uber, TripleTen, and then really the big one for me is ClickHouse. They own 28% of ClickHouse, which is basically the Snowflake for AI workloads. and they're only valued at 6.35 billion back in May. I think ClickHouse, just alone on ClickHouse, I think ClickHouse can easily be a 20 billion plus market cap business. And then of course, Nebius is going to own roughly 30% of that, so almost $6 billion. So overall, there is like a valuation floor somewhere in here. So I'm not too nervous on Nebius if it continues to fall. It's not really that big of a deal to me. I know a lot of people are saying, haha, you bought up here. Sure, that's great, but I think in the future it's going to be trading well above all the price that you're seeing here. I think we're going to make new all-time highs. The hyperscalers are just raining money over the next year. Meta alone is going to spend $70 billion in CapEx over the next several years. And so all that money that hyperscalers are spending are just going to flow down to Nebius because they need capacity and they're going to go anywhere that they can get it. So I'm still very bullish on the AI data space, despite a lot of the hit pieces and articles around the power grid and utilities and is AI a bubble and is OpenAI just kind of doing sleight of hand, borrowing from Peter to pay Paul and things like that. But as long as the demand stays there, I'm going to continue to buy the dip on Nebius. Now, just to hammer a few other points here, Nebius did have a lot more shares added by institutions in Q3. We don't know what price they actually entered into, whether it was after the Microsoft deal or before it. But nonetheless, you're seeing really big increases in share count by Wells Fargo, UBS, Two Sigma, BNP. You also have Soros Capital Management starting to take a position. JP Morgan Chase is starting to get a really big position as well in Nebius. And overall, net buying of 18.5 million shares by institutions. That is almost 24 million shares bought versus 5 million shares sold by institutions. And to note, these companies are also, you got Ray Dalio down here as well. At Bridgewater, 55K shares. BlackRock starting to nibble as well. So very, very bullish. And then of course, November 24th, the MSCI World Index, Nebius is being added to. That is going to help support the price, institutional flows, and the couples of hundreds of millions of dollars, maybe even potentially $1 billion of institutional passive flows will go into Nebius. And then of course, you got Google announcing a $40 billion Texas AI and cloud infrastructure. Anthropic as well as building $50 billion. And you can see comments here from Elon Musk. It's mind-blowing how much money is being spent on AI compute so fast, but still many orders of magnitude to go. And then being abundant on sand, plenty of sun and space, literally put it in, we can do it. They want to build data centers on the moon, crying out loud. Anyway, it's just really bullish on the overall space. I don't think the recession is going to come until things are really leveraged higher. And then there's a bit of a contraction in demand on AI in some form. And then things are going to start crashing down. And then there'll probably be credit cracks and strains. And then we'll have like a full-blown recession. But I don't think that time is now. So really my strategy here is just continue to buy shares, start buying some leaps around $76 if we can retest that more recent high. Although the previous all-time highs is right around 86, which is where we gapped up and over on that Microsoft deal. Like I said, they now have another $3 billion with Meta. So we might as well just add plus 3 billion, Meta, 3 billion deal, right? I mean, even better, right? So as long as this continues to sell off, I'm going to continue to buy. If for some crazy reason it can somehow fill this gap to 64, I'm just going to be even more excited. I'm just going to continue to buy this stock unless something crazy happens in the market, which I don't see happening. Then I'm just going to continue to buy this stock for the long term, mostly through shares, because the way that I'm playing this in the Robinhood Challenge account, which I can show you here, let's take a look at Nebius, is I've been trying to reposition as much as possible. We are down 58% on options, but we are in spreads. So these spreads still have a chance to hit in the money. If a stock can sell off 30% in a week, it can certainly bounce 30% in a week, since this is a very volatile stock and there's a lot of eyeballs on it. But I am starting to buy a lot of like March to June dated contracts in here and closer to in the money, right? So like this 105 to 110 call by June. As long as it's trading over 110 by June, this $165 that I bought this spread for will be $5, right? So a pretty decent return on these spreads. The only downside is that I just have to wait for the price to get there. Now, my average cost on shares is $90. We did buy a lot of shares a lot higher than 90, so we continue to try to sell out of other positions, sell covered calls against other long positions, and then roll that money into Nebius at discounted prices. So as this continues to head lower, I'm going to try to get this well over 100 shares, because once I control 100 shares, then I can start selling covered calls against it and running a bit of a wheel, which if you watch some of my earlier videos, I talked about once we got to a certain point, 25, 35K, things like that, then I'm going to start selling a lot more premium. And so because everything is at a discount right now, we're trying to deploy that strategy by just owning as much of the, accumulating as much of the really high quality companies that we can, that we think are very undervalued. And then we can start to sell premium on these companies once the run has already taken place. It would be silly to sell premium right now because anything can happen. The market, the stock price could be up 10 or 20% this week, and we don't want to lose these shares at the discount that we're buying them. So that's how I'm kind of running it on Nebius. Now, looking at a few other different stocks here, like Unity, everything is affected by the sell-off, right? So these high growth names like Unity hit up to 43.52, and then it rejected this gap. It failed to fill this gap. It acted as resistance. We rejected and we fell back below that 38.92 level, which has been a key level over the last several months, right? We've had a lot of resistance at this level, and then even some support here, but we sold off back to this 35.58 level. There is a lot of open interest and a lot of volume. The options chain is just crazy for this stock. I still think Roaring Kitty is in here. Despite the 30 calls coming off, we had a bit of a rally here, and then there's a lot of $60 calls on January. So right now it's kind of hard to tell. There was 45 to 60 call spreads before, and I wonder if maybe those 60 calls are being bought back on this sell-off that were sold previously inside of this debit spread, or maybe there's just new volume there. I just got to dig a little bit more into it, but nonetheless, 35.58 is the support level here. This could certainly break down and fall back to this 31 to 32 range. You got these two previous gaps that still remain. But ultimately, I think in Q1 and Q2, the stock's going to trade higher. There's still been a lot of upgrades around this $45 to $50 range for price targets. There's been some insider selling, so it's a bit dicey right now. There's no immediate setup here. It's just kind of all over the place. The overall market sell-off is just making it very difficult to predict what is going to happen. Now, EOSE, still very bullish here because power is the number one constraint in the data center build out. So both EOSE as well as T1 Energy, I'm still very bullish on. Like I said, these stocks can sell off quite a bit. They are very volatile. We had a pretty big move here and then we sold off. And similar to TE, they actually had earnings. I thought earnings went really well. It sold off into the 270s and then it bounced right back to 356. We continue to hold this bottoming pattern on T1 Energy. So I think we will hold this area. If it ever gets back into like this 260 to 270 range, I think it's a solid buy. I'm mostly playing shares right now, right? I'm just trying to stay as unlevered as possible because the market can remain can be irrational for a lot longer than you can remain solvent. And so although there's a lot of risk here, and if prices continue to drop on me, I don't really care because I know what I own, right? So as long as I believe in the company long term, if I'm buying shares, there's no expiration that I have to worry about. And same thing here with Grab, right? Grab has had a big sell-off as well, even though earnings had an initial drop, and then we fully retraced that move, filled the gap, and then fell once again, right? Like everything is just selling off But at some point, once we have clarity around what the Fed is going to do, then, I think things will start to stabilize. I don't think we're heading into a recession. Not yet. Target, they did have the ex-dividend date. Unfortunately, because Target is also interest rate sensitive, we kind of rejected here back at 99. It sold off. We took some decent amount of profit here, but gave back a lot of profit because we held it through this noise. It did rally into ex-dividend date, but then sold off. Now we got earnings on Wednesday, the 19th. I have a few positions here in the account. I'm just going to hold through earnings and hope for the best. I know Pepsi and Costco and Coca-Cola did really well on earnings, so I'm hoping that Target will also follow suit. Hims is actually in a very interesting spot. They did have a look behind the scenes. They did release labs testing, which is really just you go to Quest Diagnostics, you get a blood test, you send it to Hims, and they will tell you what your biomarkers are. This is really just another step in the direction of becoming really the Netflix of healthcare. It's like a platform to sell all different kinds of medicine, pharmaceuticals, lab testing, diagnostics. All of these things are going to be sold through Hims at some point or another. And institutions are starting to buy the dip. In Q3, there was a lot of ownership. I think JP Morgan was at over 8.1%. We're seeing a lot of other institutions buying Hims in Q3. And now it is at this long-term trend, right? Like if you just look at the daily chart, this sell-off is insane. Obviously, this is a lot to do with Ozempic selling through the White House as well as through Costco with Wegovy. But you've seen this broader sell-off in Hims. We had to move to 65. We've just pretty much got slaughtered on this position in the account, but now we are at that long-term trend line, almost 44% drop here in the last few weeks. This is probably the best technical position to buy the stock and hope for a bounce since this is the long-term trend line. I actually did enter into some more Hims positions, I believe for March and May. So really, really bullish here. I think what they released is very solid for the long term of this business. I think it's a very good product and it's just another step towards building that platform. But like I said, I did buy in here on the dip. As it touched this trend line, I think it can go a bit higher back to this 40 to 46 range. And then if the market finds a floor and stabilizes, we could definitely see it push back to the 52 to 60 range, which you can see here pretty much every time it rejects right around that 60 range. So hopefully we can get a bit of a mean reversion rally recovery here on Hims and Hers Health. And then just going down the line here, like Amazon has also sold off quite a bit. It had really solid earnings and it had an OpenAI deal. It is starting to fill this gap down. It's like pretty much halfway through the gap now. It tested this more recent high back in October. Hopefully we hold this 233 level. If not, then it's possible we could go all the way back down and fill this gap. The only way that's happening is if the market continues to sell off. But like I said, I still really like Amazon for the long term. I think once things kind of stabilize in the market, we're going to see a bit of a rally across the board. Snapchat is actually holding extremely well despite the sell-off. It had really good earnings. The partner with Perplexity, I think, was $400 million, as well as $500 million share repurchase program. We came back down and retested this 831 level and held that level as support. Hopefully the market stabilizes. We go back and try to fill this gap in the 930 range and then start pushing back towards $10 plus, which I think will happen in Q1 to Q2 of next year. I think we're definitely going to continue to push here on Snapchat. Really like what's going on with the business and how they're trying to find different ways to monetize their daily active users. Now, Upwork also had really solid earnings, very bullish on Upwork. Obviously, the landscape is changing for flexible work. And with AI, there's been like a lot of layoffs. AI is replacing workers, which actually is driving productivity for the companies, although it's not great for the people being laid off. But Upwork is a platform where people can find contract work, freelancers. I think not only is the self-serve side of the business, which is really just the Upwork platform, but now they spun off their enterprise side, which is really just landing enterprise customers. They are under now the company called Lifted, and in January, I believe it goes live. So we'll see how that performs if they're able to land larger contracts with enterprises. Overall, very, very bullish on this company. It is only trading at a 9.74 price to earnings ratio. They crushed earnings. I think this stock is definitely a good long-term buy in this range and can definitely push towards 20 to 25 range here by Q1 or Q2 of next year. Very, very bullish on Upwork. Same thing with Zeta. Zeta had really solid earnings. They beat and raised for like the 17th time in a row. But all of the growth washout is affecting pretty much every stock that you're seeing. And Zeta is trying to hold this $17 to $20.55 range. It keeps rejecting there. But ultimately, I think this is going to push higher as well once things kind of settle down in the market. And then NIO does have earnings coming up this week, so we'll see what happens there. There's been a lot of hype around XPeng, which is an Chinese EV company as well, but they're rolling out robots. And so their company has been doing really well, but really interesting to see how profitability looks on NIO at this time on earnings. They've been selling a lot of cars. I think they're almost at the 1 million car delivery mark. So company's starting to do really well and they're expanding globally. Really like the business, but you know, there's just been a pretty big washout in all these stocks. But nonetheless, we are still very bullish. Apple's holding on really well. Amazon's holding on decent enough. Google, we had Warren Buffett buy there as well. He bought back in like the 209 range, so he's already up quite a bit on his position. But I don't think Warren Buffett would be buying Google here in Q3 of 2025 if he didn't think that there was a lot more room to run. And usually once he buys into a position, he continues to scale into it. So I wouldn't be surprised if we see more money show up in Google from Warren in the next quarter SEC filings. Looking quickly at Bitcoin, we've had a really large sell-off. We had this falling wedge playing out, and now we're actually breaking below, right? So Bitcoin continues to sell off. We're not able to find a handle here. This 97K range was a decent area to go long, but unfortunately we keep selling. And right now there's just so much risk and uncertainty that risk assets and growth assets are starting to sell off, and maybe this will continue a bit lower to 90K. You got a couple different levels here to watch out for, but like I said, I think at some point everything is going to find a floor together and then we're going to continue to rally, but maybe there's more pain ahead here in the coming weeks. But like I said, if you are investing for the long term, there's not really much to worry about. Now, I guess I'll leave you with some final thoughts here. And just looking at the overall account, like the last month has been brutal. We've taken a really big step back, but this is just the nature of trading, right? Like, you are going to have wild swings in the account. You can't make a lot of money in a short period of time if you are not taking risk. And you have to expect big drawdowns like this, right? It's unfortunate that we weren't able to hedge effectively or really deploy capital in a more effective way. But nonetheless, I still think things are going to recover into the future. And we are building more of a position in high quality companies at discounted prices. And that's really the most important piece. As long as you can survive the volatility, then you're going to participate in the next run. The move from April lows all the way into October was like a generational dip buying opportunity. And everybody, doesn't matter what you bought, you are just making money hand over fist. But really trying to protect yourself and knowing when to reallocate risk is the most important piece. I wish we could have done it more effectively in this portfolio, and a lot of our predictions, although might have come true, the market didn't think so, and a lot of these prices sold off on us. But you have to weather the storm, remain in the market, deploy capital where you need to, know what you're investing in, and in the long term, everything is going to be all right. So hope you enjoyed this video. I'm going to release a video during the week as well. I know I've been a little bit slow, like 1 a week, but we're gonna try to get that up to at least 2 a week, maybe even 3. Maybe we'll go live a bit more often. I know we did the giveaway last time live, but I've been really enjoying the process here. We're gonna come back stronger, and I'll see you in the next video, guys. Peace.